The cash conversion cycle in management accounting, the cash conversion cycles measures how long a firm will be deprived of cash if it increases its investment in inventory in order to expand customer sales. It is thus a measure of the liquidity risk entailed by growth. However, shortening the cash conversion cycles creates its own risk. While a firm could even achieve a negative cash conversion cycle by collecting from customers before paying suppliers. A policy of strict collection and tax payments is not always sustainable. Well, in definition, the triple C is the same to the number of days between disbursing cash and collecting cash in connection with undertaking a discrete unit of operations. It means it's the same to the inventory conversion period plus receivables conversion period less payables conversion period. I continued, we can see is the same to every inventory divided over COGS divided over 365 days, obviously, plus average account receivable divided over sales divided over 365 days again, less average accounts payables divided over purchase divided over 365 again. We can see the derivation. The cash flows insufficient. The term cash flow conversion cycles refers to the time span between a firm's disbursing and collecting cash. However, the triple C cannot be directly observed in cash flows because these are also influenced by investment and financing activities. It must be derived from statements of financial position that are associated with the firm's operations. Equation describes retailer. Although the term cash conversion cycles technically applies to a firm in any industry, the equation is generically formulated to apply specifically to a own retailer, since a retailer's operations consist of buying and selling inventory. The equation models the time between 1. Disbursing cash to satisfy the accounts payable created by purchase of inventory, and 2. Collecting cash to satisfy the accounts receivables generated by that sale. Equation describes a firm that buys and sells on accounts. Also, the equation is written to accommodate a firm that buys and sells on account. For a cash-only firm, the equation will only need data from sales operation, because disbursing cash will be directly measurable as purchase of inventory, and collecting cash will be directly measurable as sale of inventory. However, not such. Corresponds the sixth for a firm that buys and sells on account. Increases and decreases in inventory do not occasion cash flow but accounting vehicles, payables and receivables respectively. Increase and decrease in cash will remove these accounting vehicles, receivables and payables respectively, from the books. Thus, the triple C must be calculated by trisom and change in cash took its effects upon receivables, inventory, payables, and finally back to cash. Thus, the term cash conversion cycles and the observation that these four accounts articulate with one another. Well, in the next table we can see three terms: the label, transaction, and accounting. It is used different accounting vehicles if the transaction occur in a different order. In the label A, the transaction is suppliers agree to deliver inventory. Firm overs X money cash debt to suppliers. And accounting is operation increasing inventory by X money. Credit accounting vehicle increasing account payable by X money. In the label B, we can see the transaction is customers agree to acquire that inventory. Firm is owed with cash credit from customers. The operation increasing sales divided over revenue by Y cash. Credit accounting vehicles increasing accounts receivable of Y cash. In the C label, the transaction is firm disbursed X cash to suppliers. Firm remove its debts to its suppliers. The operation, the cash flows, decreasing cash by X cash. And remove accounting vehicles, decreasing accounts payable by X cash. In the label, we can see the operation is the firms collect Y cash from customers. Firms remove its credit from its customers. The operation is cash flows, increasing cash by Y cash. Remove accounting vehicles, decreasing accounts receivable by Y cash. Taking these four transactions in pairs, analysts draw attention to five important intervals, referred to as conversion cycles or conversion periods. The cash conversion cycles emerges as intervals C and D, disbursing cash and collecting cash. The payables conversion period or days payable outstandings emerges as interval A and C, owing cash and disbursing cash. The operating cycle emerges as interval A to D, owing cash to collecting cash. The inventory conversion period or days inventory outstanding emerges as interval A and B, owing cash being owed cash. The receivables conversion period or days sales outstanding emerge as interval B and D, being owed cash, collecting cash. The knowledge of any three of these conversion cycles permits derivation of the fourth, leaving aside the operation cycles, which is just the sum of the inventory conversion period and the receivables conversion period. Hence, interval C is the same to interval A and B, plus the interval B and D, less interval A and C. The triple Z in days is the same to inventory conversion period plus receivables conversion period less payable conversion period. In calculating each of these three constituent conversion cycles, the equation time is the same to the level divided over rate is used, since each interval roughly equals the time needed for each level to be achieved at each corresponding rate. Each level during the period in question is estimated as the average of its levels in the two balance sheets that surround the period. To estimate its rate, note that account receivable grows only when revenue is acquired and inventory shrink and accounts payable grows by an amount equal to the COGS expense. In the long run, since COGS actually accrues sometime after the inventory delivery when the customers acquire it. The payables conversion period rate is the same to inventory increase plus COGS. Since these are the items for the period that can increase trade accounts payables, the ones that grew its inventory. Note that an exemption is made when calculating this interval, all to a period average for the level of inventory is used. Any increase in inventory contributes to its rate of change. This is because the purpose of the ZZZ is to measure the effects of inventory growth on cash. If inventory grew during the period, this would be important to know. Inventory conversion period rate is the same as COGS since this is the item that eventually shrinks. Inventory receivable conversion period rate is the same revenue since this is the item that can grow receivable sales. And for the final aims, the aim of studying cash conversion cycle and its calculation is to change the policies relating to credit purchase and credit sales. The standard of payment of credit purchase of getting cash from debtors can be changed on the basis of reports of cash conversion cycles if it tells good cash liquidity position. Past credit policies can be maintained. Its aim is also to study cash flow of business. Cash flow statements and cash conversion cycle study will be helpful for cash flow analysis. The CCC readings can be compared among different companies in the same industry segment to evaluate the quality of cash management. Thank you very well and God bless.